Well, this is a first in a series of podcasts that I'm going to do with students here at New York Medical College. And the first topic will be short-term and long-term effects of getting married or being married regarding financial aid and loan repayment programs. And I have with me Joshua Sterling and Alexandra West, or Alex West, from the medical school class of 2016. So they're going to ask me some questions, and I'm going to hopefully answer them. Josh and Alex?
So I guess we'll start with does getting married while you're in med school affect what you get from your loans?
Okay. Now,
and your FAFSA. Do you need to put that on your
FAFSA? Okay. At the time you're doing your FAFSA, if you are married, then you filed a joint return, or you filed a return, you have to state that you're married. If you at the time you're filing your FAFSA, you just got married, and your last return, if you have one, you were single, that's fine. The key part about this is that there was a time when we had subsidized Stafford loan, which is based on need. And we'd have to look at the FAFSA, and if it was a joint tax return, that would come into effect and could affect your ability to get a subsidized Stafford, which was about $8,500 a year. We've lost that. All Stafford is not subsidized. It's unsubsidized, grad plus the cruise interest. So in the long run, to answer it simply stated, if you're married and you have income, if it's jointly filed, it will not affect your ability to get federal student loans.
Great. How does your spouse's credit reflect your ability to get a loan? So let's say you get married, your spouse has some weird business loan that's messed up or something else in their credit history that they're working on. Can that affect your ability to obtain a loan?
The Graduate Plus loan is the only loan that credit checks students. So number one. What they're doing is they're credit checking you, the student. Okay? Now, just being married and your spouse having a credit issue shouldn't cause any problems. However, if you and your spouse went into something together and it's now a credit issue, then it would affect you. So in the law, in most cases, in 99.9% of the cases, no, it would not affect you.
Are there any specific scholarships at New York Medical College, NYMC, that would be affected?
Well, scholarships, no. Scholarships are either based on merit, diversity, merit, need, whatever it may be, and it's, again, just you, the student. Okay. We do not do credit checks on our students for our money, no. Good questions.
How about your eligibility for money? So I know some people, there's a section where the school determines need-based money that they give to students. Is
Correct.
that affected, and is that different if you file jointly versus separately?
Yeah. For us, and I'm going to answer this question later when you ask me the question about loan repayments. For us, we look at a combined income if you're married. And we also look at parental data for those need-based grants as a rule as well. So the answer would be we'd have to look at both, and that would be part of the determination. Remember, FAFSA tells us, based on the income that's placed in FAFSA, what you could realistically contribute. Obviously, on a single income, it would be X, and then if you double it or add another income, it would expect a little bit more. It's a percentage of that, but it's still, we would look at both. So it could have an effect on the amount of need-based grant you may qualify for.
So if you're married, you're still going to be looking at parental data also?
Yes.
Okay.
We're consistent in applying it to all students. You bet. Good questions.
Okay. I think that would be it for
short term.
Yeah,
more short term.
So now, with respect to loan repayment plans.
Correct. Married and loan repayment plans. All right, let's quickly go over the income-driven plans is the ones that we're really talking about, because the other plans, it's not based on income. It's how much debt do you have, how long are you taking. You know, we compute your monthly payment to be X. But on the income plans, it's based on income. And it's either 20%, 15%, or 10%. And the really popular ones are 15 and 10%. Okay. So you are graduated and you say, I want to get into the plan. They say, did you file taxes? And they look at your income tax. So if you're single at the time and you file, and even if you just get married, they're just going to go back and look at the single return. But let's say you get married in med school, now you're out and you're picking the plan. They normally would say, did you file jointly? And if you did, they would look at both incomes, your income as a resident and your spouse's income. The interesting part about it is they allow you to file separately. And if you file separately, even though you say you're married, you're only going to use your income. So that would obviously cut it down considerably. What I always tell students when we talk about this, it's important that you have a good tax consultant to tell you what happens if you file separately versus filing as a couple. Because there are tax breaks you get as a married couple. And will you wind up having to pay back the government some money at the end because you didn't take all the deductions you could as a married couple versus you getting a much lower monthly payment based just on your income, 50% of your income or 10% of your income versus double that or double and a half that. So that's the only thing. You have time to find those answers out before you make your application and use or not use the combined income. But when we start to talk to fourth-year students, and I'm going to actually invite third-year students to some of the things I'm doing with the fourth years, it's always multiple pieces that you have to ask about. It's not always cut and dry. Although it sounds great, you're only going to pay 10%, you're going to have a lot more money to do other things with. What are you losing and what are you gaining? Let me give you another one. I'll say to you, wow, you could have loan forgiveness at the end of 10 years. And let's say your residency and fellowship is 5 years. Great. That's 5 years you have in the bank of 10 years of working in a not-for-profit, right?
Right.
Cool. Now you got a decision to make. Got to become an attending somewhere, right? Do I stay with the not-for-profit sector? 5 years working, academic medicine, a city hospital, some organization, I'm the staff physician. Or do I take the private practice route for the last 5 and not get loan forgiveness? Well, so let's suppose your loan forgiveness could be $150,000, $175,000. But in those 5 years in this example, when you did your residency and a year or two of fellowship, you have 5 years you stay in the not-for-profit. What if you're losing $30,000 a year in salary in the not-for-profit versus the for-profit? 5 times 30, that's quite a bit of money. You have to weigh that. It's worth it. We can get by, we're married or whatever, we can get by on a little bit less. But look, after 5 more years, I never have to think of student loans again. That's the kind of thing I'm saying. When we get to those times and when you have to make those decisions, we have to make sure, it's my job to make sure, that I lay out in front of you all the possibilities so you can make a decision that's best suited for you. They're all good options, but that's how we kind of do it.
When they're calculating the amount of money you're paying in these salary-based loan repayment programs, do they take into account whether or not you have dependents?
Yes, that's it's a great question, and it helps. In fact, there's one great calculator that I always share with the graduating students, that you put in your income, your debts, and how many dependents, are you single or married, and it does the calculations, and having dependents makes it better. Also, here's another important piece to that. Although you can't combine and consolidate your loans with a spouse's loans, you can use the total your spouse has and add that to your total of loans. And I hate to say this, but the more loans you have gives you more leverage with your income rising, where you can still stay in that plan and only pay 10 or 15%. So yes, there are some pluses. You can have, if you have dependents, it will lower the payment some. And if you marry, and you are allowed to file separately as well to keep that payment reasonable. So good question. You're asking all the right questions.
So if you entered into the percent income
Income-driven plan.
right, loan repayment plan, and then get married later, is it only based on your tax return? Do they
Yes.
look at that? So
It's always going to be evaluated every year for those, if forget, it's not just 10 years. I mean, you can just
Right.
forget the loan. I'll be in it for 20 years, 25 years, whatever. They always then say, okay, it's time to reevaluate, you file taxes, so on and so forth. And so
every year
it's
based
back
on
to that
your
again.
tax.
Separately or filed jointly, yes.
Is there any consideration based on, or is there any cost of living consideration? So based on where you live in the
Not
country?
really, no. Yeah. They only ask a question about Alaska for some reason, but that's about it, yeah. But it seems to work out. Well, I shouldn't say that. I remember speaking to a grad student who was had a very high rent in Southern California, went to Cedars, right? Had to forbear at least the first year, maybe 2 years, because his rent was so high based on his salary that getting into the repayment plan would not have worked. Remember, it's only a percentage, Let me give you an example. If you're making $50,000, which is the average starting salary, residency PGY1, let's say your take home is about $3,200, because they take withholding taxes out and you settle come tax time. And your rent is $1,200. Your payment under that 15% plan would only be about $410. So theoretically, I can manage on that. I can do it. But if your rent is going to be $1,500 or $1,800 a month, you're starting to cut your margins a bit. And I don't want students struggling, at least that first year, until your salary starts to rise. If I remember, in this case, it was $46,000 or $47,000. So his take home was under $3,000, and his rent was something like $15,000 or $16,000. It was going to be problematic that first year. So it's a matter of knowing where you live. So I answer your question that it could have an effect if you're in a very high cost area. You're being paid a little bit less than the average, and you can't find rents lower than less than half, perhaps, of your take home.
You mentioned that your other debts kind of affect your repayment, what they calculate as the amount you're paying back with the income-based plan. Does that include private student loans?
No, I'm glad you asked that question, Alex. What we're talking about, all of these repayment plans, are just for federal student loans. However, undergraduate federal loans, post-bac thing, you started another plan before you're going to be a pharmacist and decided to change. Any federal student loan is part of the equation, but private student loans and alternative loans are not. And that's why you don't hear us at the school ever pushing private loans, because it's the options that you won't have. The interest compounds a whole lot faster. You don't have the same kind of deferments. You have no loan forgiveness. So I'm glad you asked that. Now, if some students had to borrow those private loans, the kind of thing that we do here in fourth year is strategize. All right, you may have a zero payment on your loan, federal loans, and still have those months count. So that's good. That means you're not paying off your federal loans. They're counting towards the loan forgiveness. Now we can take whatever little money you have, $300-400 a month, let's start addressing your private. So we kind of do those kinds of strategies if private loans exist in your life. And we have some flexibility.
You mentioned you suggest people going to a tax advisor or tax specialist. Do you have any that you recommend students go to?
Well, here's a couple of things that I want students to have once they leave. You need a good lawyer, not because you're going to be sued, but you need a good lawyer who's going to go over contracts. You may want to get into a business or a practice, or you'll be an attending, and you want to look over any obligations that are put your way. So you need a good lawyer. You need a good tax accountant. And most importantly, you need a good certified financial planner. And I stress the word certified. And certified financial planners can be tax experts as well. So you could use a lawyer and a good certified financial planner. Because student loans are only one piece of your life. Mortgages and family and other obligations and saving for retirement, although who thinks of that in your 20s? But a good financial planner will want to lay everything out. They'll have the information about your student loans. Do you want to buy a property? You're having family. Do you want to save for their education? Do you want to save for retirement? You want to have some fun and start to work all those things out. So those are the things that I stress. To answer your question, we have a financial planner that I always have the fourth years meet in a seminar. We do it typically in March, right before the match. So I know a lot of fourth years are around, and I'm definitely inviting third years or anybody to go. He works primarily with physicians. I've known him for over 25 years. There's never an obligation when we bring people in. We don't even, I get nothing from it, the school, he just comes in and gives advice. There's always an option to use that person. The one way I would answer the best question with accountants and with financial planners is to find one who's certified, a certified CPA, a certified public accountant, or a certified financial planner. There are associations, you can go online and you can find out about credentials, and they could recommend some people that you will interview. Do you like working with this person? Do they seem to be interested? Do they have the background? Have they worked with physicians before? I think that's important. Because physicians are going to realize a certain kind of income that the average person doesn't, and there are many more things that you can do with it. And there's many more tax breaks you're able to get as well. So I try not to recommend to people because if it doesn't go well, and then there's always a suspicion, is he in it on something, or is the school? So you can come to the session, you can interview the person, you can talk, and if it works out, fabulous.
Okay.
So this is great. I appreciate the questions. You asked just the right kinds of questions I would want your classmates to hear, and I want to thank you for this opportunity.
Thank you for taking the time with us.
All righty. Bye-bye now.